So let's try to see if I can get this question. It's spaced out oddly in the format. That's why it's taking me so long to read it. But here's a question. I'm going to start reading it the same way I'm seeing it. You're going to follow along. I mostly do credit spreads and balanced credit iron condors. At the year end, I decided I was tired of being challenged on the upside, okay, and had to only do bull put spreads. Several of my orders to close my bull credit spread positions were triggered and closed this week instead of a few weeks out, and you reopen some of those bull put spreads higher, closer to the market on the same underlyings. The account was up 10% this week only using credit spreads. Might you care to talk about naked calls, bull credit spreads, and other approaches to this current market and its coming gyrations? Okay. Well, this question is from Mark. Okay, Mark. Fantastic. So what we're talking about here, an iron condor position. Now, for those of you that may not have traded this or you're new to it, an iron condor is a combination of a bull put credit spread, where I buy a lower strike put and sell a higher strike put to create a bullish risk-reward profile. My stock might be trading at around, say, 100. I may sell a 95 put and buy the 90. Now, it's a bull put spread. At the same time, I may enter into a bear call by selling a 105 or 110, depending on my outlook for the position. We'll say selling a 105 and then buying the 110. So now as long as the stock stays between 95 and 105 for the next 5 days, 10 days, or 15 days to expiration, all 4 options will expire worthless, remain out of the money. We keep the double-dipped net credit from the bear call side and the bull put side. And of course, our margin requirement would be the difference in the strike prices minus the net credit. Okay? It's a neutral position. And like Mark, both Ernie and I stopped trading iron condors altogether probably about 2.5 years ago. The reason why is because the upside kept getting violated, even back in 2016, end of 2015. So we were mainly just doing bullish spreads, bull put credits, bull call debits maybe. And if we saw an opening, based on the criteria that we used to add the bear call later, where the stock had moved up and now we thought it was hesitating and likely could pull back, and we still had 10 days or so left on the trade, we would leg into the position and add the bear call after to complete the iron condor. But I have not been opening iron condors by themselves in the past 2.5 years. Just like Mark, I was getting this edge cut too often, where I'd have to roll it, adjust it, and was taking losses or having to position myself to go much further out in time in order to do that. Okay? So that's probably the main issue, is that in the market, the way it's been, the iron condors were difficult. And some investors I've talked to would do skewed iron condors. I just didn't understand the point of that. A lot of times the combination didn't make sense. What do I mean by that? Again, our stock's at 100, and an investor might look to sell, let's keep with that same number, a 95 put and buy the 90 in the bull put spread because they're neutral to bullish. But rather than going to the 105, the 110, or the 115, they do a very skewed bull bear call to complete the iron condor, where now this side is up to 120 or 125 even, and they're buying the 125 or the 130. So it's 20 points out of the money on the bear call side and only 5 on the bull put. Well, this credit here, oftentimes, you do get a credit, but it might only enhance it by 5 or 10 cents, depending on if you're doing weeklies or standards, okay? So I don't like to do the skewed iron condors. I'd rather keep myself personally with the standard bull if I think that's still the direction the market's going to go. I don't know the direction the market's going to go. I don't have any insight on that for you. So related to Mark's second point of the question, the real meat and potatoes of this question, is that he's up good this week, but could you care to talk about naked calls, credit spreads, and other approaches in this current market? Now, what I can tell you is that from our research and our analysis, I'm still doing bull put credit spreads right now in this market with the default weekly bull put spread screen that we tested on a 1-year, 2-year period, and those final results of the going through all of 2017 are going to be posted soon. And as you may have seen from our credit spread presentations, what we found had the best return over 2-year, 3-year, and 10-year period was actually going to the 2 weeks out. Different combinations using only 1 strike apart, using 5 strikes apart, or using less than 1 strike apart, and trying to go 5 days out or 3 days out to the standard week had less of a positive return than starting your position going about 14 days out in time. Going 2 weeks out in time with the weekly options, we always saw a higher return. Now, as you can see, I look usually for very high probability. I'm starting with 75, but I'm actually sorting my results by highest probability. So of the top positions we see in the results, we're looking at trades that only have a 4 or 5% return for a 14-day period with 95, 96, 94% probabilities above. I don't have the confidence enough yet, Mark, in the market and what's been going on to start doing iron condors again. And honestly, until I see a correction or a glitch of any kind, and I saw that with some of my tech stocks in the past 3 days, but until I see something change, and it's got to be kind of dramatic in a sense of, a good 2 to 3% decline in the market over a 1 or 2 or 3 day period, I'm not going to do naked calls right now either. I'm not doing any bearish positions yet. I haven't changed because I haven't seen enough in the current market in the first only 4 days, drop in the bucket time frame, to convince me that I can find just as profitable bearish positions, bear call spreads, or naked calls, as I have been finding successful positions with bull puts and naked puts. It still feels neutral bullish. I can't explain why. I expect there to be a correction soon. It's probably going to catch some of us off guard, which brings me to another point. Let's take a look at the Alta Salon bull put, and we'll just go to the profit and loss chart. With Alta at 215, with Alta at 238, right now we could sell the standard expiration 215 put for about 53 cents and buy the 210 for 30. I can get a better return, a much better bull put spread return-wise, by maybe selling the 220 and buying the 215. That might get me to a 9% leveraged return on this bull put for a 14-day period. But the probability is probably going to dip below, maybe 75%, maybe below 80. Okay, so this is much more conservative, although the credit's low, only about 22, 23 cents. The return is reasonable for a 2-week trade. Yes, you can do better, and that's why most of you are using the margin, but long term, a bull put credit spread portfolio, forcing it to be an 8 or 9% return in a 1-week or 2-week period, ends up taking more losses over time, where the final outcome is not as high as being more conservative. Okay, again, those results will come out soon. You'll be able to see those posted and comparisons as well. I'm doing that for David H. that I had a coaching session with yesterday. I just didn't get to do the 3 different comparison tests I had mentioned, but we'll have those available for you soon. So yes, I know there's fear in the market. The market sentiment tool on power options even kind of turned over to a bearish sell warning based on the 13 broad-based parameters that we use and the fences that we've set. But going back to this position, the key here for me is until I see that kind of correction, I'm not going to go into naked calls. I personally never trade naked calls. We're going into earnings season, so a naked call or a naked put is going to be kind of risky if there's an unexpected decline. I'm not going to trade one of those positions or even a credit spread, bull put or bear call or iron condor, on the stocks that have earnings between now and expiration. I could just focus on SPX for iron condors or SPY, but I was still having a problem looking backwards, getting violated on the bear call side, where the bull puts, of course, hindsight 2020, were more profitable than opening the iron condors and then being forced to manage the bear call side. Now, back to this position. It is a 5-point spread, and I'm only collecting, as I mentioned, 22 cents for utmost safety, very high probability. It's only a 4.6% yield, and I've already mentioned that, yes, we could do better with the selling the 220 and buying the 215, or maybe even selling the 225 and buying the 220, going up to maybe a 12 or 15% leverage return for 2 weeks. But in either case, I have a 5-point spread. I'm getting 22 cents, so my maximum risk is $478 per one contract. First thing I make sure with credit spreads, and this is just credit spreads, I'm not talking about the naked calls yet, but on credit spreads, even if it's an iron condor, I'm going to make sure that I'm only trading this with 10 to 20% max of my total portfolio value. Why? Because if I have 5 bull put spreads open right now that have been successful and doing extremely well for the last year, but Monday or Tuesday, the correction happens, all 5 or 10 of those spreads could go to a max loss of 80 or 90% in a day, depending on the market fall. Meaning that what I had invested in credit spreads, if I'm doing too much, could wipe out much more of my portfolio than I want. So first, 10%, 15%, maybe 20% max of your total portfolio should be allocated to these types of positions only. Number 2, the maximum risk on any spread, that monetary risk, and if I take the worst case scenario, so the risk on any spread should not, in my opinion and in my practice, represent more than about 3 to 5% of your total portfolio. Okay, so what does that mean? Now, if I've got a $100,000 account, I'm going to allocate $20,000 to trading spreads. Of this 478, that's the maximum risk in the worst case scenario, I'm going to make sure that the number of contracts I trade, so if I did 3 contracts, let's call it 500, 3 contracts would put this up to a $1,500 risk. 6 would be a $3,000 risk. And that's about the limit. I'm only going to do 6 contracts in a 100K account because that just represents 3% of my total portfolio. So if that one goes against me, I suddenly was in a winning position. Alta opens up on Monday at 205, and now I'm at a full loss. That monetary value on this one spread does not represent more than 3-4% of my total portfolio value. And if I had 10 positions open, you still see the problem. If that drop comes on Tuesday and those bull put spreads all drop to where I'm now at close to 75-80% loss on my bull puts, if all 10 of those represented 5%, that starts to add up very quickly, doesn't it? That's the risk. That's why it's important to not only focus on the structure of the trade, the criteria for the underlying stock, but the proper position sizing and making sure that even though you're doing leverage spreads, which are very lucrative and can be very lucrative, that you're practicing proper position sizing and nothing takes on too much risk. With markets gyrating, part of your other question there, you know, doing naked calls and things of that nature, what is a naked call? Okay, a naked call is about the most bearish thing that you can do. It's when I just sell an out-of-the-money call, not covered by the stock, excuse me, folks, not covered by the stock, or another option such as in a calendar spread or in a credit or debit spread. So let's say I was bearish on Alta, or maybe even bearish on the market as a whole, and I'm going to sell the 250 call and get 142. Now, depending on your broker, this is going to require a lot of margin. This is a naked call position. Like a naked put, but I'm bearish. The risk here is if the stock moves up, and a potential outcome is if the stock gaps up and is suddenly trading at 275 or 276, I'm going to be short shares of stock at 250. I'm going to have to cover that for that 10, 15, 20 point loss on the position. In a market that's gyrating, it's difficult because it's moving up and it's moving down and it's moving up and you get hit to a trigger and you've got to manage this, and then it moves down and you're successful. You roll this back, it comes back up, you roll it back out again, and it's kind of difficult to go with that routine. Okay? What is the answer? Well, I'm not going to tell you to do short strangles where you sell a call and sell a put here. I know a lot of you are interested in generating premium, but in a market that's gyrating back and forth, you're getting hit on stops and paying more to buy back these options to roll to a higher strike price, and you can end up getting trapped. Or you may end up having to roll this out 2, 3, or 4 months and tying up the margin requirement for an extended period just to kind of get back to break even. Is the answer then, if we're talking about selling calls and we're having to manage them real quickly in the short term, iron condors and credit spreads, is the answer then to buy a call? And then maybe as the stock moves up, you can roll the call, or if it moves down, buy a put, and then go in and out of long straddles and strangles. Well, the advantage there is that the volatility is low right now. It still has been. So it's not costing as much to buy a 2-month out, 3-month out call or put, depending on your expectation of the stock, and then try to manage it with buying a put when the stock, starts to move down, or you think it's going to start moving down after it's hit its peak, and legging in and out of the long calls and long puts. It's expensive. It's not generating premium, but it is risky as well. Okay, let's see. Hold on. All right, so I know there's a lot of questions. I'm just looking at here, okay? I'm just going through all the lists, and there's... Okay, so I'm on David's question now, but I'm trying to see if there's something here on these... There we go. Okay, good. So I like to generate premium. I do it with roughly 25 to 35% of my portfolio in positions such as bull put spreads I'm still doing, as I mentioned, not doing any naked puts right now. If I'm interested in a stock, I'm buying the stock and buying the put as a married put, and then do income off of it later. Until I see a shift, I don't think I'm going to change out of bull puts into bear calls, but I may do that depending on what we see in the coming time. I am doing long options, buying calls and puts, but it's more around earning cycles. I'm not doing iron condors. I don't have the confidence yet in the market to say that it's going to stop moving. And like I said, I could get caught with my bull puts. I've sort of dialed back the amount of money I'm putting in bull puts right now until I feel more confident one direction or the other, even with those 95, 96% probabilities. But yeah, I don't want to do anything naked right now because of the projection either direction. I'm not doing a short strangle where I'm selling a naked call and a naked put right now because of still unknowns of the market correcting one direction or getting forced up to higher directions as well. And I've already talked about the iron condors, not doing anything neutral right now until I see a change or something in the broad-based indicators, which almost kind of did come up today, so I'm waiting until Monday to see something else. But I'm still keeping with diagonal call spreads, bull put spreads, the married put positions, and the standard collars that are protected. And anything you're doing has to have the proper position sizing in there as well, okay? All right, so those are my thoughts there on going forward. You see here the market sentiment change. My settings are a little bit different, so I don't know if this actually converted to a bearish sell today for our market sentiment, which is 13 broad-based indicators, put-call volume ratio. Number of days the SPX has been up, and then we set fences based on 10 to 12-year historical fences, historical ranges. You see the VIX is near its low, of course. The number of the percentage of new 52-week highs to 52-week lows on the stocks has entered the bearish mode as well. RSI on SPX is bearish. Number of days over the 20-day moving average and over the 100 is forcing new limits almost. So these are the 13 broad-based indicators we use. Mine are set a little bit differently than what Ernie has set, but a bearish signal has been triggered. I'm watching that, and if I start to see movement on Monday or Tuesday, I may close my bull puts early or manage them. Hey, I may even buy to close the short put for a profit if enough decay has happened and leave the long put open for another 8 to 10 days, see if I can profit in that direction. Okay. Okay, so we're going to move on to Rajiv here. He says Rajiv is having doubts on AMD and Intel. He has bullish positions on AMD and he's bearish in Intel. Volume still high on both. When to close both positions. Okay. Here's an annoying rule I have that I tell customers, and not that I'm dodging the question, but when a customer calls, schedules a coaching session, visits me on one of our webinars here, and asks me, when should I consider closing the position? To me, the best time to consider closing a position is when you've already asked yourself, is it time to close the position? You're not comfortable with it. You're going to be watching it consistently. You're going to be trying to decide, hey, does this really, I saw a little crossover today on the MACD or stochastics turn, or something happened with the Bollinger Bands. Is this the signal that I have to get out? Do I have to watch it for the next 10, 15, 20 minutes? It'll drive you insane. So if you've already got it in your mind that you're considering getting out of the position, it might be time to get out of the position. Now, you give me an example. You've got the 12.5 call on AMD for the February 2nd expiration. I don't know your cost, okay? But I'll just put it in at today's cost. Now here we go with the position. We've got a long call on AMD. I put in that I bought it at 58. Your price might have been a little higher or might have been lower if you're very speculative. Do we have anything coming up between now and February 2nd on AMD? Let me go to the stock research tool. Let's see what we've got here in the details. All right, so it's down 24 cents today. That's a pretty significant drop on a $12 stock, so about 2%, which probably brought your call percentage down maybe by 10, 12, or 15% from where you started before the morning. Okay, and it's got some other things here. What am I looking for? There it is. Okay, so the next earnings on 1/30/1. It's unconfirmed. I don't have a full confirmation on that. It's going to be sometime around the end of January, beginning of February. You probably have looked at investors' relations and seen where that is. The data we have, it's not confirmed yet based on our sources. It might update this weekend. We'll see. All right. What has AMD been doing? Now I'm going to look again at the stock chart. Okay, I'll take a look at big charts real quick. And it popped up, but then pulled back. Okay, so you're kind of following. Let's go to I'll show you what I do here. 2-month or 3-month chart. I'll stick at 2 months in this case. My indicators, I'm going to use a simple SMA using the 20 because I want to look at Bollinger Bands. I'm also going to look at MACD. I don't really use stochastics that much, but you can select that as well. I'll put in RSI and then volume. All right, so this is how I customize big charts. Usually I'm looking at a 6-month chart when I'm opening a position. We're going to cut it down here. Now see, it broke above. Ernie would consider this a Bollinger Band breakout, meaning that it broke above the upper band and closed above it and then closed above it the next day. But it pulled back today. Usually you see a lag and then you might see it come back up. You've got a positive MACD signal here where it's moved up above the divergence line and it's broken above the EMA line as well. Now, RSI has dipped down because of today's movement, which is more of a lagging indicator. Now, a lot of times when you see a Bollinger Band breakout, you kind of have a tendency to see a pullback and it move back up. Not every time, but it can happen. If I'm looking at this chart, I don't know when you got into your 12.5 strike. Naturally, we can't do anything today. I'm waiting to see the performance on Monday or Tuesday. I'd expect it to drop back down towards 11, but then it may continue back up in price. Let me go back 6 months. And I'm just going to try to pull up something here. One of my trades. Okay, let me go back. Oh, sorry. Let me just go back 3 months. That might be better for us. All right. So now here's what I'm talking about. And you commonly see this and sometimes you don't. But here's that Bollinger Band breakout. Now this was because of an event. So it closed above the upper band, closed the second day above the upper band, even the third day. But now look, it starts to hesitate. And then it continues its movement upwards. Like I said, does it always happen? No. Here it broke the band, opened below it, and closed above it, but then it kind of closed right at. But it did, and then it pulled back. When do I usually close a position in this case, Rajiv? So I see the Bollinger Band breakout, I see a hesitation, but I leave it alone if I see that what I think was a Bollinger Band breakout. And then it starts to hesitate and it drops. When it drops below the 20-day moving average and I get a MACD crossover, that's usually an exit for me. I did not exit this position, by the way, that I was in, even though it was at 34 and it dropped all the way down to about 32.20, 32.70, I think, 32.70, 32.80. I didn't because I'm bulletproof on this position with a 30 put to it's actually 10.1% now. So I'm going to make 10% even if it fell below 30. And I have a 35 call sold against it that I got 70 cents for. So I could buy it back cheaply right now, but that expires in January, so I'm leaving it open. It's sort of, one of these where I have absolutely no risk on the position. If I still had 5 or 6% risk on this position and I saw this move and then it pulled back below the 20 and I had the MACD crossover, I probably would have closed it right here to avoid further losses. This one triggered back up. The market continued to lift it back up. So again, I cannot give you direct advice on your stock positions. I can say that the minute you start asking yourself, is it time to close the position, you're already considering it, and that might usually be a good time if you think there's a better choice out there. As I mentioned with the Bollinger Band breakouts, sometimes you see it, sometimes you don't. This was not a breakout, by the way. It didn't close above the Bollinger Band and then above the next day. It barely closed above and was below the next day. Okay, but here we've got a close above, a close higher, might be a pullback like we saw in Planet Fitness, and come back up. But if I see it drop below the 20-day and I have that negative MACD crossover at the same time, that's when I'm getting out of the position. And it could drop on Monday. We could see drops there as well. I don't know. But that's something to consider on the position. Okay, so let me go here. There we go. All right. I didn't mention it this time in the webinar, but I'm going to ask Dana to do this for me in a moment. One of the slides that I had up made a reference to, I may ask you for clarification on your position or your question. A lot of times I get a question, Mike, do you do a Jade Lizard? Do you do a three-legged box spread? Do you do a double reversal back spread diagonal with protection? Well, I don't know what that really means. All right, so I'm going to ask you for clarification on that structure so that I can properly answer it. Dana's question is further down the list. I've got about 4 more questions to get through to Dana's. But Dana, I want to ask you, your question is, do you do pairs trades, and can you show how you were doing with pairs trades? My answer to you is no. I don't do pairs trades. Second, while I'm answering the other questions, can you please comment, what is a pairs trade to you? I know that sounds silly, but I've had 5 discussions over the last 3 years of people doing pairs trades. And the pair trade for customer A was completely different structure than the pairs trade from customer B, which was different from the pairs trade being used by customer C. So I need to know what your definition is, your structure that you're looking for on a pairs trade to properly analyze it. But I can tell you right now, just from what I know of pairs trading and the conversations I've had in the past, I do not trade them. So I kind of can't give you any thoughts on that as well. I know what they are, but I can give you thoughts on them. I can't give you any record or how I'm doing with pairs trading, depending on what your definition of a pairs trade is, because I'm likely not trading them in my personal account. Okay? All right. Now, Rajiv, real quick, you had mentioned, here's a tricky part. You had mentioned that your cost for this 12.15 call was 116. Okay? It's at 58 cents right now. You're at 50% loss. That's usually a trigger point when I might decide to close or roll a call. You got to wait till Monday anyway, since you haven't closed it now. But again, that's one of the triggers. I don't know when you opened it, where the stock was when you originally opened it. But my trigger points for a bull put spread, a long call, or even other strategies, but let's just take this. The first thing I do is based on my stock sentiment, and I already showed you that. If I had entered a long call position, a bull put credit spread, a bull call debit spread, or possibly even a diagonal calendar spread, it would have been a stock that was above the SMA 50. Sorry, the handwriting is terrible with this pen. It's not even a pen. So that looks like stick, K, S, zebra, Greek letter SO. Okay, but stock would be above the SMA 50. I'd have a positive MACD crossover, which we just saw on AMD. You know, we saw the MACD line above the signal line. It just moved above the divergence line. That's still positive. And this might have been the 20-day moving average instead of the 50. I may have used Bollinger Bands, but I also would have looked for stocks that had other fundamentals. Now, why am I listing these? Because if this was three of the criteria that I used, a Bollinger being up above the upper Bollinger Band or at least in the 85 percentile or higher of the upper band, positive MACD and SMA 20, if any of those go negative, I'm likely getting out of the position. And as you just saw, I will use a combination. I will use a confirming signal. So if the stock drops below the SMA 20, but the MACD is still positive, might not close it yet. But if the stock drops below the SMA 20 and the MACD turns negative, I'm exiting the position. If the stock moves closer to the lower Bollinger Band and there's a negative MACD crossover, I'm likely exiting that long call position. Okay, confirmation signal. So those are some ideas. I know a lot of investors will set a target on their call premium. On a stock, if you buy a stock or enter a covered call, you might set a 7% stop loss. If the stock falls 7% from your purchase price, you're going to look to exit or adjust the position. Can't do that on a long call because you'd be out of every position as soon as you open it just due to the bid-ask spread. But you may set a stop at 40% to 50% of your loss. Why that high? Well, the reason why it has to be that high is so you don't get stopped out each time. But again, you're losing 50% right now. It could open up on Monday and you could be down 90%, in which case just hold the position because you're already at full loss. If you hold it through February 2nd, you might get some bump and be looking good. Okay. Now you could average down or do other things of that nature, but that's up to you. If you want to put, you could buy, kind of ladder it. You could try to buy an 1150 call with stock at 1188. That effectively puts your strike price at an average strike of 12 with an average cost of 116 plus the new call divided by 2. I don't know. Some people will ladder down and throw more money into the position, and you have a new average cost, which is still higher, but now your break even might actually decline. That's also a possibility. So those are the triggers that I use. And this one here, you're at that mark for the premium itself. All right. But again, you've got 3 or 4 weeks to go. The market could be tumultuous in the next 1 or 2 weeks, or it could remain the same. I'm not here to tell you that. You do have earnings coming out probably sometime before February 2nd, though it hasn't been confirmed yet by my data. But that's probably why you got into the call, not only because you were strong on AMD and it matched your criteria, but also because, hey, if it's good earnings, I can get a really good advantage of this as well, and that might be what you're looking for. Okay, so let's go down here. Let's take a look. Okay, so, all right. Okay, that's just Rajiv. Okay, so he created the bull position. Okay, so we're looking at some of the things there for Rajiv. All right, good. Now, next question. We're going in order. So in order, the next question's coming up. I've got, well, I'll just comment on Steve. Steve says, sorry I'm late. Glad to be with you from bitterly cold Maine. 16 plus inches of snow. Steve, I'm glad you're here as well. Thankfully, I'm only at 4 or 5 inches here currently with, I think I'm at an 11-degree temperature, dropping down to about 8 degrees, not including wind chill. I know you're much worse, but I'm glad you made it through the storm so far. Hopefully the quote-unquote cyclone bomb is not still over you. I think it's mostly petered out here. So we got it much less than you did, but I'm glad that you're here. Hopefully things are going okay and you're staying warm. Arvind says, hello. Please let me know that if I have a covered call for 1 year after, and do I get dividend or not? Arvind, I'm not sure I understand your question. If I bought a stock today, let's take AMD, all right, just as a covered call. I think they pay a dividend, but even if they don't, we'll just use this as an example. If I bought 100 shares or 200 shares of AMD at today's price and sold the January 2018 12 call for $237, 1 year out in time. Okay, so I've got a 1 year out covered call 26.3 max percent return with some reasonable downside protection, very reasonable downside protection. You know, the break-even's at 9.49 here on a covered call on AMD. Now, if AMD pays the dividend, if you have a covered call open, do you still get the dividend? Yes, until you're assigned. Is there a risk of early assignment? Let's say we have an ex-dividend date on AMD coming up on January 15th. And I'm out to January 2019, so I'm still a year out. Most likely your year out call will not be assigned early. If you had a January 1912 call and the stock was trading at 11.95, 11.99, 12.01, 12.02, 12.05, and so forth, and the dividend was 20 cents, which would be extreme for a stock trading at 12, but if dividend was 20 cents, you might get assigned early on your 2018 January, maybe your February, potentially. But this far out, you wouldn't worry about early assignment. And yes, you're on record of owning the stock. Selling the covered call does not cancel the obligation of the dividend, or the rights, I should say, to receive the dividend. Okay, so moving forward, that's what you might look for in that strategy as well. Okay, but yes, Arvind, you'll still get the dividend if you sell a call that's 1 year out in time, a covered call position. Greg W., good question. We touched on this a little bit last week, and I didn't get too far into it, and we were going to do a comparison. It was a little bit different than what you're asking specifically, but we kind of covered this last week. Greg's question is, what are your thoughts on doing a calendar spread on SPX? Have you ever done this? What is the risk versus reward? Okay, well, I'll be honest with you, Greg. I do diagonal spreads, calendar calls, calendar puts, where I'm buying an in-the-money call or an in-the-money put far out and selling a near-term call against it. Any stock that's over, any stock that's over about $120, I will trade as either a calendar spread or a bull put spread, because I'm not going to trade it as a married put based on my account size or a standard collar either. Similar positions, but a little bit subtly different. So in a diagonal spread, I'm going to buy an in-the-money put that's maybe 3 or 4 months out in time and sell an at or out of the money call against, buy an in-the-money call 3 or 4 months out and buy an at-the-money call. My typical structure, that's not it. My typical structure for a calendar spread, this is too far, is I usually go about between 10 to 25 days out on my short option and upwards of 120 days to, or more, 4 months to 6 months on my long option. Okay, I don't want to go too far out of the money with the short option, but in SPX I might be able to do that, and I don't want to go too deep in the money with my long option. So a structure for me for SPX, let's just go back to the custom spread tool. If I was opening it today, I probably look at least 2 to 3 weeks out on the short option. Oh, sorry, forgive my groan. These new weeklies, look at this. Mondays, Wednesdays, Fridays, Mondays, Wednesdays, Fridays. I'm sorry, Monday, Wednesday, Friday, Monday, Wednesday, Friday. Oh, I just make it more and more difficult each cycle for SPX. I have a feeling, I joked with Ernie 6 months ago, that I have a feeling that eventually all these weekly options that we have in a year or maybe 2 might actually open up to daily option expiration. So on the top 20, top 30 stocks in the indexes, you'll have a Monday, Tuesday, Wednesday, Thursday, Friday expiration. This one's already getting close to it. I just don't know if that's too much. I don't know if that kind of hurts the volatility that some of the option sellers look for with having too many choices and too short of expirations. It kills the brain if you're doing double diagonals or diagonals, because now there's just too many strikes to choose from. Do I go 2 days out, 4 days out, 6 days out, 8 days out, 10 days out? Enough of that. I'm going 14 days out with my short option. Okay, I'm going to go just at the money but a little bit out if I'm still bullish on SPX, knowing that we don't know the future, of course, and knowing things could come about. Well, I think 27.50, 27.60 is a better strike. So I might sell a 27.60, But then we're going to go out somewhere here, April to May. Oh, those are quarterly, May 30 quarterlies. Maybe I'll go June. Let's go June, 161. That's going to be expensive, and I know this. And I know the market could correct. In some cases, we could expect maybe a 10% correction over an extended period. So I want to give myself some good room here. Geez. Well, unfortunately for me, I can't do this position either. Now, that of course means that you might be able to. Why can't I do this position personally? I already told you that I'm not buying shares of stock that are above 120. I'm also not buying calls that are above $184. I might go SPY in this scenario instead of SPX because I'm only going at 2,700 here. And if I'm rationalizing that a 10% decrease in the security is possible, that's going to put me below my long strike price or close to it. Not saying it's probable, saying it's possible. But again, let's just go back to what we're looking at. We're going to go ahead and take that 2,600 just to look at the risk-reward ratio. I'm going to sell the near-term 2,760, buy the 2,600. Again, I already mentioned I'm likely to use SPY in this scenario rather than SPX because of that monstrous cost of the long option. Okay? All right. All right. Okay, so let's say, I'm sorry, just going forward on some questions here as well to see what the comments are. And I did see that other comment that just came in, both from Dana, excellent, and as well as Greg. All right, so here's our spread. I don't like it. Whether I went too deep in the money, I don't like this return for a 14-day trade. I can do better with other stocks that I'm probably just as neutral to bullish on. 7.3% 14 days, though, as a potential if the stock's trading right here is good. I have two ways to lose, and my break-even is only 27.40. Based on the value of the long option, the Black-Scholes pricing model, the break-even doesn't look good to me. This isn't a good trade. All right, let me try SPY, see if I can get a better combination just off the top of my head. I'm going to stick with the standard January 14 days out. Knowing volatility is low, there's not a lot of premium for those out-of-the-money ones. Sorry for the scrolling, just got to get to just there we go. We're at about 273, 275. That's about where I was, 85, 88 cents. Maybe I don't need to go as far out as June. I really want to, though. I don't want to go to March. I know some of you are buying 3-week out calls and selling weekly against it for your calendars. That's something we talked about last week. We'll try April instead of June, but I still want to go in the money. I still want to pay that much. 10% here, 27. Shoot. Yeah, 265 or 260. I'm staying with it. Now, I'll have to take a look at this when I enter it. I'm doing this on the fly here, so I'm not sure if it even matches my criteria. Net debit of 1137. Okay, I would never trade this. I'm trying to put together combinations for you, but I can tell you right now, I would never trade this position. I'm getting 87 cents for the near term, and I went in the money a little bit on this 265 call, but the midpoint's at 1224. How do I know just by looking at it I wouldn't make this trade? First rule for any calendar, the net debit of the position, which in this case is 1137, has to be less than the difference in strike prices. In this case, it's not. The difference in strikes is 10. So this is a no-go. Why wouldn't I do that? Why am I so focused on that? Because if SPY, which it wouldn't, but as a general rule, if SPY gaps up in price and goes above 275, my broker assigns me early, or I get assigned early, I now have to, my broker may decide to exercise my long at 265 to deliver my short at 275. I only get 10 points back. My debit was 1137. I had a successful trade, but I'm at a loss at 137. That's a no-go. The debit has to be less than the difference in strike prices. I'm not saying every combination is like that, but it's starting to look like they're priced right now further out, maybe because of market uncertainty going forward, that these debits wouldn't be less than the difference in strike prices. So that's something to look out for. That's a consideration. When you ask me, what do you consider about spreads on SPX, calendars on SPX? If I can't find a position with debit is less than the difference in strike price, I'm moving on. Honestly, I am. I could sit there and go crazy trying to find better combinations. Jim points out something. Let's take a look. He says, we'll go further out in time on the short option. Very well. Let's see, we were at 14, 21. Yeah, let's go 28 days out. Let's go to February 2nd. Same strike, 275. 155, 160. I don't think it's there yet. I honestly don't. So now I'm shortening my write cycles, the amount of times I can write against my April option by going 28 days out in time. Debit's still above the short option strike price, or it's bigger than the difference in the strike prices. So that's a no-go for me. Until I can find a combination that matches that criteria, I don't know if I'm going to enter it. So that's the first thing I'd look for. And of course, Greg, I can use the search tool to do it. Meaning that I'm sorry, I just was looking at the wrong one. So let's go to calendar call and let's go to search. I'm going to clear everything out, and I'm going to put in my criteria, Greg, that I just mentioned. Regardless of cost, we're going to go all expirations for the short expiration time frame, but I do want it to be at least 10 days out and probably no more than, all right, let's go 30. And for my far expiration, I'm going to want to be at least, let's call it 120. I'll shorten it. How about 105? But probably no more than 190. Okay. Now, for me, this shows up as a net credit, but it's really a debit. Okay. So the negative net credit is the same as a debit. So I think I want my negative debit, my debit, to be greater than, and this sounds strange, I've been after the programmers to fix this, but the debit has to be greater than, for my account size, $75. That's for one contract, and we saw that price, but I'm going to increase it here for our needs. I'm going to go up to 110. Okay, so what I'm saying is a debit has to be less than 110. Yes, I'm going to want at least an 8 or 9% return minimum, and that's the max return at short-term expiration. I'm sorry, folks, that there's hovering over too much stuff there. My apologies. Long option delta, I do want to be greater than 0.6. My delta ratio should be greater than 1.6 as well. And my debit to strike difference ratio has to be less than 1 for me personally. Now, I've entered all that, but I'm going to go to the fundamentals, and now I'm just going to look against SPX. So I've set my option expiration time frame to where I want. 10 to 30 days for the short, 105 to 190 for the long, debit of less than $110. Max return on the first cycle of greater than 8, long option delta at least 0.6, but my delta ratio, delta of long divided by short, has to be greater than 1.6. My debit to strike difference ratio is less than 1. All right, I don't think we're going to find anything, probably because of my debit price. Yeah, I'm not debit price, I'm sorry. Yeah, that. Let's put this up to 210. Not something I would do. I'll lower this to 5 as well. Okay. Let's take out all the deltas. I'm even going to take out the debit restriction. Max return of 7 on SPX, leaving this filter. There are no combinations on SPX where using the net debit, where the debit to enter the position will be less than the difference in strike prices. So I'm going to say no, I'm not going to do it. Now, someone did bring up a point, and I was getting to that. On SPX, it is a little bit different, Greg, because I had mentioned the reason I make sure that the debit is less than the difference in strikes is because of early assignment. That's true on SPY. Let's try SPY. But see, on SPX, you don't really get assigned. It's all cash settled. And you can't be assigned until expiration, which is the benefit. Yeah, I was getting to that. But again, it's still the structure of the trade. I don't want a net debit to be less than the difference in the strike prices. I want that there. Now we're going to try it on SPY. Just with those basics. And still, There's nothing on SPY in these time frames. No other restriction for in or out of the money, implied volatility, delta, debit. Let me take my max return down to 3. There we go. Okay, so there we go. The max return, 6%, 3.2%. There are some that are here. 19 days versus 161. The June series I was looking at versus some of the Januaries. Okay, so these are some combinations here. The return is small, and there's only 6 of them. And I'm going because it's going far out of the money. You say, well, why is that going so far out of the money to 280? Why aren't you looking at the 275s? Because there's no combinations with the 275s where the difference in the strike prices is less than the net, is greater than the net debit. That's why they're not showing up. So I might enter some of these potentially. But again, 14-day trade first cycle, 6.7, 6.6, 3.2. Can you do better with another security that you're neutral to bullish on with this trade? Probably. The other idea that was asked last week was about the double diagonals, comparing double diagonals on SPX, which is sort of a different structure. It's almost like an iron condor, but you're buying a farther out wing of a long call and selling nearer term short call and short put as well. So instead of buying an in-the-money call, I'm buying an out-of-the-money 5-month out call and selling a near-term at the money or slightly out of the money call. It's like a bear call spread, but farther out in time for that option that you're buying. And he wanted to compare selling 1 week versus 2 week calendar spreads on SPX and what could he expect for returns. And the first thing I thought is that how is that actually going to be able to outperform just doing an iron condor week by week by week? And the same result happens that we talked about earlier in the presentation for Mark and what I've done in my personal account. The double diagonal spread and the iron condors kept getting violated on the upside. So I stopped doing that 2 years ago. I haven't been doing double diagonals and I haven't been doing iron condors. I've been focusing on diagonal spreads like this, calls and puts, with about 10 to 15 to 20% of my portfolio that I'm allocating to options trading. But again, I can't tell you how this is going to perform because it's not really matching my criteria, but you can see what you're kind of looking at. You can find multiple spreads, SPX and SPY. Okay. Now you had a follow-up quick question before we get to our others that have come in. David's got a long question come in. Jeff's been waiting patiently. What portfolio hedge do you recommend against market correction? Buy long puts on SPY? If it doesn't change the whole dynamic of your portfolio, perhaps. How about buying calls on the VIX in case there's a market correction? 1 month or 2 month out calls that are really cheap. So if the VIX spikes, you get a good return. That's a possible hedge. But long term, the cost of that insurance might totally wipe out the gains on a credit spread or a calendar spread portfolio. This is coming soon. A month ago, we did a part 1 and part 2 analyzing how many puts or calls you would need to buy on an inverse ETF, broad market-based ETF, or others to protect a certain size portfolio. It's on the Power Options blog, part 1 and part 2. I haven't done part 3 and part 4 yet because I wanted a longer-term view of actual market. It takes a while to compile, and I wanted it to be real. So what am I doing? I simulated $1 million account and bought about 12 to 13 stocks on August 1st. Some of those stocks are up 55% over that time period doing nothing. Others are down. The total portfolio gain from August 1st to current is 7% on those 13 stocks, allocating half of the entire portfolio, $500,000 to those 13 positions. Now what we're going to do is we're going to go back in time on that portfolio and we're going to see what would have cost to insure that portfolio month by month by month with SPY puts, or one block of SPY puts to insure $500,000 or of a certain percentage, because that's the key. You're not insuring the entire portfolio. That'll cost too much money. You're insuring a certain percentage of your portfolio against a market decline in that scenario. So how much would it cost? Of that cost, how much of the return would it have taken away from your portfolio? Buying VIX calls month by month by month out of the money, which are inexpensive, but you watch that insurance disappear. Okay? other ideas, trying to create an elaborate ratio spread where you have insurance to the downside, but you receive a little credit up front, which may actually increase your risk if the market continues up, which is what happened. So these types of things, that's what we're looking at. The two-part series so far is called Stock or Portfolio Insurance. And we're going to look at the last 5 months of that actual portfolio to identify the true cost of insurance, what it would have cost you, how much it took away to the portfolio. As an example, Burlington Coat Factories is one of the ones in there. I think Lending Tree is as well. Burlington's up about 55% since getting in the position. I don't think it's Lending Tree. I think it's Dollar Tree is in there too. From 8-1 on is also a gain. But there are one or two positions in that portfolio that have dropped 12 or 15%. And all of them are even position size. The portfolio itself is only up 7%. So right away, you can see, you know how much that profit would probably be more than cut in half right now by the cost of insurance over that time. So I wouldn't have taken as much gains on it. And if I insured the positions directly, it would have cost more. But my loss on the one that lost 12, 15% would have only been 5%. But then the gain on the 55% would have only been maybe 42, 43%. But we're going to look at that more in depth. So when you ask me, how would you insure a portfolio? What is the first? Go back and check out those blogs. Okay, that's, if you haven't yet, go and check out part 1 and part 2, because there's some interesting things I think in there that you have to ask yourself first before going forward. So just blog.powerop.com. Okay, we're concerned about a market decline. So here's one for the stock traders. And the first thing you have to consider is, how much of my portfolio do I want to insure in the worst case scenario? In other words, if the markets drop 10%, what would the loss be on your portfolio? And if you had a 10% decline or a 15% decline in your portfolio, you can't protect against all of that. You're going to have to take some loss, but are you willing to only take a 5% loss or a 10% loss in the case of a 15 or 20% decline in your portfolio? Okay, that's the first question you have to ask. Number 2, you can say, well, would you just hedge it with SPY? It's a good broad-based market indicator. But again, if your portfolio is mostly in NASDAQ stocks or Russell 2000 small cap stocks, why would I be using a put on SPY? I've got to follow my portfolio. Now, if you're solely planning on trading calendar spreads on SPX or SPY, sure, adding a put to that would help, and it would help hedge against it. But now the question becomes, how much does that change what your position actually is? Are you really in a calendar spread anymore? The answer is no. You're in a different structure, and that's okay, but is it going to match your trading goals long term? That's the question, and we don't know, because it's great not to take a loss. But go ahead and check out the blog, blog.powerop.com. Go back into the old series, part 1 and part 2, back from the beginning of October there, and then we'll have 3 and 4 coming up soon. All right, Jeff, you've been very patient. You've got not a simple question, but you've got a very direct question. What is the minimum amount of money you need in your account to work with power options? It depends on the strategies you're looking to trade, but we feel that you should have at least $10,000 of free capital that you're willing to risk in options to trade the different strategies. And that includes buying calls and doing bull put spreads. Why? I have customers that do come up to me, Jeff, and say, hey, I've got $500. I saw a webinar where someone was claiming they made 6 trades in the last 3 months, and 5 of those trades gained 300%. Right? They're buying calls. And he says, okay, well, can't I go in and buy calls with $500 and see 300% returns? No, you might, but there's no way you can guarantee that, right? Any customer that calls up that got lured into options investing by someone overhyping 300, 500, 600% gains and says to me, yeah, I'm looking to trade because I only have $1,000 to invest in the market and I want to see these profits everyone's talking about with options, I tell them not to. I don't tell them not to call me ever again. I tell them that they should not subscribe to power options. They should not follow our education, because the best thing they can do for themselves is build up that account a little bit more. And when they get, maybe $7,500 or $8,000 or $10,000, now maybe they can start doing long calls, but only do it with 40% of that portfolio, maybe only $4,000. But I'm not saying if you only have $4,000, you should start buying long calls. Okay, that's not what I'm saying at all. I'm saying that expect to lose. That's a bad mantra, I know, but we're dealing with investments that are derivatives, that are leveraged. If you only have that amount of money, you're not doing conservative positions as married puts where you have to buy the stock, or such as collars where you have to buy the stock. You're not even doing covered calls, which I don't even consider conservative, but the brokers try to sell it that way. Excuse me, with that amount of money, you have to be very cautious. And I'm not saying you have this little amount of money. I'm just saying you have to be very, very cautious because, as we talked about, what you've seen with Rajiv's position, not to pick on Rajiv, but he probably only has 2 or 3 contracts of that AMD call we looked at earlier. He bought the 1250 call for 116. It's at 58. You take $4,000. You buy 2 calls or 3 calls on Apple that are priced at around $16, $17. You've got $4,800 invested in Apple calls, and Apple drops 5%. Your $4,000 is down 25, 30% on a one-day movement. Unexpected news. Before you know it, you could be at full loss. With the credit spreads, same thing. Leverage works both ways. So that's why we suggest $10,000. That's why we enforce proper position sizing, that even if you are doing credit spreads, the monetary risk of that credit spread, the maximum loss monetarily, the difference in strikes minus the net credit times the number of contracts should not represent more than 3, 4, or 5% of your total portfolio value. So that's why we feel confident saying the 10% or $10,000 for these types of strategies we advocate. And you probably want to break it up into a couple different strategies, but you've got to practice proper position sizing or it can come back to hurt you. All right, Dana's follow-up real quick. And then David's question, and we've got a couple more. So we're going to go over, as always. No, I don't mean it that way, but we're going to go over a little bit here. I want to make sure I get it. Dana's clarification into these pairs is that I'm looking at the spread between 2 stocks or ETFs, but you don't trade them frequently. Don't worry about it. It's just trying to learn. Thinkorswim platform has a trade section for pairs, but haven't seen any trading. I'm not one to really advocate one education service or the other, especially one that's not my educational service or my educational teachings, Dana. But for the pairs trading, you might find education on a website called stockbrokers.com. I referenced that last week. I don't get anything from plugging them, but they had a good information on the different brokers that were available and comparing the different brokers as well. Okay, they might have something on this pairs trade because it's more of a stock trade look and a stock strategy than options. Okay, now if you're trying to look at the money strikes on stocks versus ETFs to try to find variances of the bid-ask spread and line up ATM options as a pairs trade, my suggestion might be to try looking at Sosnoff, the former sort of founder user of Thinkorswim there, Sosnoff's Tasty Trade educational platform. Do a search on his archive videos for pairs trading or something along those lines. You might find something. You're right. I don't touch them. Now, why did I ask you for clarification on that? This is similar to what I thought you meant, but I wasn't positive. Of my discussions I've had in the past of investors asking me what about pairs trading, one investor specifically asked me his idea of pairs trading. Yeah, it wasn't him. His idea of pairs trading was he wanted to buy SPY and then hedge it with also buying shares of SH. So he wanted to be long the SPY, the SP 500 ETF, but also long the short ETF, the inverse ETF. And at first when I looked at it and I said, well, where's the benefit? One goes up, one goes down. How do you gain anything in this scenario? And I asked him, was he legging into it? Was he going to wait, buy an SPY, wait for a bull move, and then buy SH and hope for a bear move? Or how is he going to control that? And no, he was going to go in at the same time, buy both, and just let them run. Not even do covered calls against them. It boggled the mind. Then I did realize, though, that the inverse isn't really directly one-to-one. There's subtle caveats and differences between them, and so he maybe could have made a profit based on that, but it still would have had to have been bullish. But again, going back to the hedge question that Greg asked, buying shares of SH itself is not a responsible or financially responsible way to protect your long shares of SPY. It costs too much money, and that's why we have options in the first place. So yeah, my suggestion is look at maybe a place called stockbrokers.com. They might have some information. If you do a Google search, you'll probably come across Investopedia. They're not going to have any great information. But check out Tasty Trade as well, Dana. They might have some information there on their pairs trading, or if they structure it there with their long stock positions and ETFs, or using options, at-the-money options, depending on what they're looking for. Okay. All right. So I'm failing Dana here. I don't have the great discussion on pairs trading for Dana. Not something I do, not something I've studied. I've heard 3 different variations on it as well. So I'm not guaranteeing Tasty Trade is going to have anything, but they probably have something out there. It does surprise me, and here's my other thought on that, Dana. It does surprise me that TOS would have a trade entry, but not education on it. And remember, Tom Sosnoff was involved in the beginning in Thinkorswim. So if they have pairs trading in there for a reason, he might have been a part of that. He might be sharing some of his pair trading ideas over at Tasty Trade as well. But not something I touch, so not something I could comment on, good, bad, or ugly. So yeah, this is one where you guys got me. You're going to have to find a better resource because I don't have it for the education in this realm. Straightforward, I don't have it. So I'm not even going to comment on it. All right. Other than to try to point you in a better direction. Okay, so David's question now is if I'm in a radioactive trade, a married put, and I've sold a call, and the call is approaching or has surpassed the short call, and you need to roll out, but an earnings report is coming up, okay, but I would like to stay in the stock, and you should never be in a covered call position during earnings. I never am. The guidelines, okay. Okay, and then you're going in depth onto the analysis of income method number 6, which I'm probably not going to get in today, David. I'll reference it, but I won't. All right, so David's situation here, I'm gonna force a position. No, I'm not. Yeah, I'm gonna force a position on AMAT. Yep. Okay, so let's go ahead and build an RPM that doesn't exist, but I'm just going to use it as an example. Let's say that a couple weeks ago we bought into AMAT when it was at 51.55 or so, when it really pulled back. And at the same time I had bought the July 55 put, but it would have cost me around $7, $7.25, I think. Yep, that's about right. So I've got a far-term married put with a 6.5% risk on the position. And the stock's at 54.60 today, but it's been moving up recently. So the other day when it's at 53.70, let's say that I had gone ahead and sold a February 16 55 call for 110. Okay. All right, so here we are with a radioactive trade. The income method number 1, call sold against it. Stock has moved up. It's trading near the short call strike price, but if I'd sold the 54 and it was at 54.60, or if the stock was actually trading at 55.60, we're in this realm where we want to be a little bit concerned. And let's say earnings are coming up. I've got the February 55, 16, February 16th, but let's say earnings are coming up on January 10th or January 15th, somewhere in that time frame. Okay, so what David's talking about is I want to give myself more room, and I may consider rolling this call. Okay, so what are the rules of thumb? Depending on what, you saw it here, but depending on what I already collected for the position, in this case it was 110. But we saw the actual price was around 228. Okay, so the actual price is around 228. So rolling this is going to cost us more than we originally received. And we're not in the money yet. But again, we know there's earnings coming up. So the two things I might consider is A, it's going to hurt the position, it's going to increase the risk, but I may just buy to close the short call and not roll it. I personally don't have a short call open ever when I'm going through earnings as just an income method number one. Now, it's after the fact. I would have done better beforehand, but what I could do now is keeping the same expiration or going closer in. I'm just going to keep it similar, going the same expiration. It's not going to be a good combination, but I can convert it to that income method number 6 right now. I may consider buying a higher strike call. The 60 call, 74 cents. That lowers my net credit, but it still leaves the upside open. Well, that's if the stock goes to 60, 65, 64, so forth because of the earnings announcement. Unlikely, and it does. I could still take a loss here, but it's not going all the way negative because of the short call. Now, I'm not even saying this is a better structure than what I'm in right now. But again, I might convert it to an income method number 6. More than likely, I'm just going to buy back the call. In this scenario, by the way, David, I never would have done this. That's me personally because of what I look for. When I was in this Mary put and the stock was moving up to 55, it's not there yet. If I knew earnings before I sold this call for the 16th of February, I would have checked the earnings. And if I saw it was on January 10th, I never would have sold the call to begin with. Okay? I would have waited. I might have adjusted the put to lower the risk before earnings. I might have converted it to an income method number 12 for the January 10th or January 15th earnings. By the way, I don't think that's when AMATs are. I'm just using this as an example. We'll look that up in a minute. But I never would have sold the call in the first place to an expiration past earnings. I always look at that first before doing anything. Now, at this point, when I did sell the 110 call, it's possible that at the same time, we could have sold the 57.5 call. I'm sorry, bought the 57.5 call to complete income method number 6. It might have only cost us 45, 50 cents. Probably, yeah, I'll say that, 57.5, 45 cents. That's about right. So now this is a more attractive. This is an income method number 6 I'd consider, where it doesn't go back into the double-digit loss and I'm heading into earnings. Okay? Know what is coming up on your stock before just doing an income method because an income method is available. And that doesn't really answer your question, but with earnings coming up, I may consider just buying to close the short call and leaving it open. I could try to convert it to an income method number 6, but this is the profit and loss chart I want. I don't want this second spike or this second bump to go negative, which usually what happens when you try to do an income method number 6 right away or too soon on the position, or in doing it after the fact when you sold the call and said, oh wait, now the stock's still moving up, I should leave the upside open and buy a call. Well, you're going to create a position in those two scenarios where you get that second way to lose, and then the stock really needs to take off to get back into the unlimited upside benefit. I want this with income method number 6. Now, to your other question, it's a little bit more advanced, and advanced in the sense of mostly just designed for blueprint owners and so forth. Here's the deal. You said in the blueprint, it indicates that one of the rules for this income method number 6, which is really a bear call spread, but done in the proper context of the married put, generates income and leaves the upside open. But in the blueprint, it says you want a 2-to-1 ratio. So I wouldn't enter this position by selling the 55 and buying the 57.5 unless the net credit, $1.25, unless the net credit is equal to half of the difference in strikes, 250. It's a guideline, really. It's a good rule of thumb, but it's a guideline. So I need a net credit of 125 to be able to do this. We're not there, are we? We're at 110 and 45. So we're looking about a 65-cent net credit, which is roughly, as you mentioned, 1/4. Okay? And then you said later on in one of the discussions, you saw someone, probably me, personally, where it says that it says you want a 1-to-3 ratio, where this could be as low as maybe 75, or not 75 cents, I'm sorry, but with a 250 strike difference, that it could be 3-to-1, so about 80 cents, 85 cents or so. Okay? And in all honesty, you may consider going to 1/6. Now, what do I mean by that? It depends on your time frame. This is why I'm redoing most of the videos for radioactive trading, the Mastery Series CDs. And it's because that at the time, you didn't have all this. And I know not all stocks have the weekly options, but at the time, you didn't have all this. That's something that has to be considered. What is your time frame? 14 days out in time. If I'm in this married put, I'm sorry, let me scroll back down. I know it's annoying when I do that, but let me resubmit this married put. Bought stock at 51.55, bought a July 55 put for 7.25. Now the stock is there. I'm considering an income method number 6, where I'm keeping it 14 days out in time. I could sell the 55 for 90 and maybe buy the 57 for 31. All right, so it's a 2-point spread, but I'm getting about 60 cents of credit. And that's another thing. Dollar strike differences weren't really available when income method number 6 was originally written. So you see this 2.5 reference. You got to consider 1, 2, and more. All right. So now I'm under a 50-cent net credit on a 2-point strike difference, so it's 1/4. But think about, look at the profit and loss chart. Does this match my goals? Yep. Doesn't double dip. Gives me infinite upside. I've reduced my risk by about 65 cents or so. Let's call it 60, we'll call it close to 60 cents even, 58 cents. And it's over $2. All right, so this is about 1/3, right? 3 to 1. But it's for 14 days, okay? This bear call spread by itself, without considering the context of the radioactive trade, is about a 41.8% return for 14 days. That's more than justifiable. Now, I'm not saying you should do 5-cent net credits on income method number 6 because it's 5 days out or 3 days out. Not doing that. I'm just saying that this is an okay trade. It's 60 cents. My original risk, remember, was about 7%. This lowered the risk by about 1.4, 1.5% from where we started on the AMAT position for 14 days. That is fine, okay? I know it's confusing, but it's because there's more confusing things out there. Things that were written 8 years ago in 2007 need an update for the guidelines. I still keep the same guidelines for income method number 1, but you've probably heard me say that, you know what? The original rule there was the net credit had to represent at least 1/3 to 1/2 of the original risk when doing income method number 1. And I stand by that if you're 30 days out in time. If you're using weeklies and you're 2 weeks out in time, 1/4, 1/5 might be okay. That's fine because it's for 14 days. And if you're going 7 days out and trying to force weeklies, which I don't always recommend, but if you're using weeklies because it matches the rules, the rule there might be 1/6, honestly, because it was a security type that wasn't available when it was originally written. So I update them on the live webinars. I discuss it, sometimes post blogs about it, but that's why you see discrepancies, because things change. I'm so sorry. The benefits of radioactive trading, the benefits of the 12 different income methods do not change. But the ability and the rules of thumb for when you're selling a call or doing an income method do change when you're talking about 7 days out versus 30, 14 versus 45, and so forth. 2.5-point strikes versus 50-cent strike differences on a bear call spread. I had a customer the other day, no, this was months ago. Was it after Halloween? I think it was the Halloween one, the Friday discussion right before Halloween. Was asking me about a weekly income method number 6 that was for the next week expiration. He was taking in 9 cents, 8 or 9 cents on a 50-cent strike difference. So he was selling the 55.50 and buying the 56 and getting 8 cents. And he said, is this a good income method number 6? You know what my response was? I said, well, does it match your goals? Does it match your needs? And when you graph it, I said 55 here at 725, right? And when you graph it, does it match your goals for the position and what you're looking to accomplish? Because if it doesn't, then no, it's not worth it. But as far as following that hard guideline, I think I said 51.55, 51.50. Whoa, what did I do? I did that. Sorry, folks. That's better. All right. So now this income method number 6 to me, even though it's 14 days out, still looks pretty good, right? I had that original risk about 7.5%. It does lower it by about 2% with a 60-cent net credit. That is more than fine for a 14-day outcome to lower the risk by 2%, and I don't go negative again. It's in that 3-to-1 ratio, but even if it was a little bit lower, even if the net credit was only 50 cents, I've lowered the risk by 1.8% from 7.5 to 5.7 if my numbers are still right, and I don't double dip. I still think this one's okay for a 2-week trade. It still looks good. Okay. All right. So that's where I'm coming from on that, David. It's regarding income method number 1. I wouldn't open it I wouldn't sell to open income method number 1. I would have looked at the stock first, and if earnings were coming up before the expiration I was planning on selling, I would have done a different income method. Doesn't help you now that you're in it. So what are your choices? I would consider the effects of buying to close that call now and leaving the upside open. And if it still moves up before earnings, considering adjusting the put up to lower the risk, or income method number 12. You could consider trying to convert it to an income method number 6 right now. I don't think you're going to see the risk-reward profile you'll like that's going to match your goals. I think that you'll see one that ends up double dipping back into the loss range, okay? Okay, I'm not sure, Jim, I understand this question. You say, how can I save the settings for a strategy in a text printable form? Now I only know that I can save it using the snipping tool. I guess you're talking about going into a search for a given strategy, and then are you asking me to save? You want to save the screenshot of the active filters? And how to set the settings for a strategy in a text printable format? There's no way to do it. We don't have like a download for it. If you want to, if we tell investors that if you want to save the search criteria, well, or your adjustments, just save what you have, and then you know what you have, or write it up. But no, I don't have a way to export the block here for the active filters for a given strategy. I can't think of any other way to do it other than what you're already doing, using a snipping tool or just writing it out typing it out, in a Word document manually. Jim, if you have the time, why do you want a printable version of the criteria that are used in a given strategy? Is it for discussion? Is it for sharing? To show clients, not clients per se, but show other fellow investors or things of that nature? Just curious. I've never heard anyone really ask me that before about printing the criteria out as well. Okay, water break, real quick now. Another question has come in. Rajiv. One more question on assignment. I had a bear call position on CSCO. Okay. Don't own the stock. Sold the January 39 call and, sold the 38, bought the 39 on Cisco. Okay. It was assigned to me, all happened yesterday. And so in a hurry, he sold the 39.5 put for January 12th. Now shares move past 39.50. How will I manage this position? Rajiv, what position are you still in? Let's see. So, okay. I may have read this wrong. We're in Cisco. And January 19th, I'm assuming. And I thought we talked about this last week too, but you said 38, 39 call, and it moved past 39.50, which was your put. Oh, in a hurry, you sold. I'm sorry, you 39.5 put for January 12th. Okay. Well, that's okay. That's good. So what I'm reading here is you originally in a bear call spread that you might have gotten 10 or 15 cents of net credit for. Call this 20. Let's call this 10. Okay. Oops, not buy. That's a sell. And we don't even need it right now. But what I'm seeing is, let me take out the short put. Good. All right, so maybe a bear call spread like this, where you sold the 38, bought the 39, maybe had a 10-cent net credit for 11.1% return, but now you're saying it got assigned. So I'm assuming you got out of this position, that you were assigned on the short, and then you either exercised the long to deliver the short, so you took the max loss of 90 or 89 cents or so. Okay, so we've got a loss of 90. Now, in a panic, not in a panic, but in a hurry, the stock was moving up. You figure, well, if it keeps moving up, what can I do? So you now sold a January 12th 39.50 put, and maybe you got 30 cents or so for it. But actually remember, oops, you didn't get 30 cents for it. You did, but you paid 90 cents to close the other one. So really, hate to do this, but you've got a cost 60. You're selling for a debit of 60. So here's your profit and loss chart right now. All right. And you're asking me, what can I do? How will you manage this position? Okay. All right. Well, here's the trick. You got into this trade on a panic or on a move. It expires next week at 39.50. You're using this hedge. Now, I'm showing it a debit of 60, but remember, you had a loss of 90, and you're taking in a third against it or so, assuming you got maybe 30 cents for this put. Okay? Well, your original plan was panic, but you still want to get most of that 90 cent. You still want to start to cut into this 90-cent loss. So really, you're hoping that Cisco, to me, stays above this price. You're going to try to get the most of that 30. You really want it to expire worthless. I know that sounds obvious and redundant, but that's what you want. There's no way to really close or manage this position out. You're in a different position. You're at a naked put where you need the stock to stay above 39.50 in the next 5 days to make 30 cents, which hedges 1/3 of the total loss you took on a previous position on the same stock. So focus on this now. Don't worry about this. You know you have that loss, but your goal here is not to complicate this position, not to overtrade this naked put. Your goal here is to try to make as much of this 30 cents as possible. And as you know, this is dangerous because what could happen on Monday? Stock goes right back to 38.50. Now you've got $1 cost basis to buy this back, so you've got a loss of 90 from the previous spread, a loss of 70 if you buy to close this put. So now you're down $1.60 on Cisco, trying to manage these shorter term positions with the stock flopping around. This, by the way, is a pretty good example of what was asked earlier in regards to what are your thoughts on credit or debit spreads and naked calls in this type of market? Well, here's an example of the trap. We had a bear call spread that we had to manage. It got assigned. You were maybe even hoping it would pull back below 38, but you couldn't because it got assigned early. So you're out of it with a loss, the full loss on the spread. Now you try to manage it with another directional trade, even if this was a bear call or a bull put, or just a naked put. You're trying to manage a bull put with a naked call, as was asked earlier. Well, what's the risk? We know the risk. We're going to have to wait till Monday to see, but if it starts to pull back, we've got to do something with this short put quickly. Maybe roll it out and further out in time. You're fighting this battle of 4 or 5 day out trades where you're only getting 10, 15, 20 cents of net credit and spending $1 to buy it back. That's going to be tough. And your repair on the position, you're making 1/3 of what you lost back on it by getting 30 cents. That's good, but in order for that to happen, Cisco needs to stay above there. If it drops further, it wiped it out. That's the risk, okay? So for right now, we've talked before about things I might do to protect the naked put position or manage a loss on a naked put, but right now your goal, your approach is you're trying to see this option expire worthless to hedge the 90-cent loss you took on the original spread or to cancel it by 1/3 in the hope that you get the full 30 or 60 cents. I'm sorry, 30 cents here. This is a debit of 60. That's why it's showing the loss. But you want the most of that time value that you sold into decay in your favor. Start hedging that loss. All right. Okay, Jim says he wants to compare the strategies side by side to see the difference. All right, Jim, later on this weekend, if you get a chance, or next week, send me an email. I'm just kind of curious of how you would use the criteria as a comparison against one another. I mean, because we show what return you're looking for, but you're not really showing, you're not seeing what return you're getting. In any case, I'm just curious there as to what you're kind of, oops, sorry. I went to the wrong screen. Obviously, you can tell that. All right, so let's just go here. Breaking through some of the other stuff we talked about. Just there we go. All right, so I just want to remind everyone, my apologies. It jumped over again before me to the slideshow. I don't see any other questions coming in. If anyone does have any last-minute questions, send them our way. We're already 10 minutes, 7 minutes past the hour. But if you haven't done so already, remember, go to Power Options at any time. Just go to powerup.com, put in your first name, last name, and email address, and you can go ahead and click Start My Trial. We'll send you a password. You'll have full access to Power Options for 14 days to test out the tools that you saw today, search capabilities and the 23 different strategies, custom spread tool, portfolio analysis that we didn't see today, and more. And after that trial, of course, remember, we've got the different subscription levels starting at $40 per month. That only gives you access to end-of-day data. So the data is only updated at the end of day. Then we do, of course, have the 20-minute delayed service at $60 per month. And we do, of course, also offer the real-time and access to the historical tools, where our historical data goes back to April of 2006. Free stuff. You saw an email probably today already talking about this. But remember, you can check out the blog at powerup.com, the recent thoughts that Ernie put together on the market parameters and his little market forecast. And those two-part series of the Stocker Portfolio Insurance is available there. We're going to address that sometime later this month, in the middle of the month or a little bit later, with parts 3 and parts 4. As mentioned, you can access our archive webinars at any time. Just go to powerup.com/webinars.asp and check us out on YouTube. Today's presentation was recorded, of course. I'll get that posted for you guys over the weekend. It'll be available. I'll send you an email on Monday or so when the webinar is available. And last but not least, if you do have other questions, send me an email at any time to support@powerup.com or to support@radioactivetrading.com. You can also call the office during market hours. Trial members and subscribers, remember, you can schedule a coaching session at any time. So just click on the free coaching link there and you'll see a scheduler to go ahead and select a time that matches your convenience. In addition to that, the end of year offer for the blueprint was extended, but it does end at midnight Friday tonight. So if you haven't picked up the blueprint and you're considering it, you have another 6 hours or so to pick up your blueprint before that special end of year offer with those bonuses expires worthless before the offer goes away. So, but in addition to that, we'll be back next week with other webinars. I hope you all have a fantastic weekend. Thank you all for joining me today, and thank you for your great questions. And Dana, I'm sorry I could not venture further into the pairs discussion for you. I just would be not able to give any good advice, and I'm not even going to try to waste your time by doing so. Thomas says, thanks, Mike. Stay warm, Thomas. You too. Everyone else that's underneath the new Arctic blast that was brought by the bomb cyclone, I hope you all stay warm as well. I hope many of you have shoveled out already. For that, I do actually have to run out and grab some things, because this will be the first time I'm leaving the house since before the snow started around noon yesterday, so I've got to get some stuff. But other than that, take care, everyone. Have a fantastic weekend. We'll see you for our next trading week, the first full 5-day trading week of 2018, it looks like. And we'll also see you on one of our live webinars next week as well. Good night.